Hello, I'm Anna Kasatkina and you're watching InstaForex News. Last week, the Japanese currency climbed to a 15-year high versus the US dollar, and this value is now so far below the extreme price of 79 yens. At the same time, another issue emerged. The profitability of 10-year government bonds fell under 1% for the first time in 7 years. And this happened in the country where the ratio of the debt to the GDP is around 200%. A low cost of credit can be good news for the Japanese authorities, though a strong yen is not an excellent item. The currency markets are developing in phases. However, there are 4 basic factors manipulating the currencies: payoff difference, a considerable economic growth, deficit or surplus of the current account, and relative inflation. It is obvious that the investors and traders are not buying the Japanese currency because of profitability in the short-term and long-term prospects. In reality, the yen has been decreasing for a few years due to carry trade, and the investors have been borrowing money in order to buy more profitable currencies of other countries. A relative economic advance is true. An expected economic growth in Japan in 2010 will amount to 3.1%. On the average, the indicator is similar to that of the USA, though the tempo is foreseen to decelerate to 1.7% in 2012. The net surplus of the current account. One of the reasons for the long stability of the yen is that the trading partners of Japan have not stored excessive yens. As a result, Japanese accumulated a huge debt which it owns to citizens. The current account surplus is predicted to be 3.6% this year. As for the inflation, in fact, Japan faces deflation even stronger than the official estimation shows, 1.5%, which denotes that 1% of the governmental debt's yield can already be considered an acceptable result. Keep in touch with the latest financial news provided to you by InstaForex. Goodbye.